Okay, so you want to buy a bank. Find a building, hire some tellers, and watch the interest payments roll in. Simple enough, right? Here is the strange part. A bank is one of the only legal businesses on the planet where you are literally allowed to create money. Not earn it, not borrow it, create it. And yet, more than 500 American banks have failed since 2000. Some of the most powerful financial institutions in the world have collapsed overnight, wiping out billions in shareholder value and taking entire economies down with them. By the end of this video, you will know exactly how that is possible, how banks actually make money on the inside, why having access to essentially unlimited cheap capital still is not enough to guarantee survival, and why a bank is not really the business most people think it is. What it actually costs. Banks come in three sizes, and they are three completely different businesses. A community bank, the kind you see on the corner of a small town in Ohio or Georgia, costs somewhere between $12 and $20 million to start from scratch. For that, you get a charter, a handful of branches, a loan officer who knows every farmer in the county, and a customer base that has been banking with the same institution since their parents opened their first checking account there in 1987. A regional bank is a different animal entirely. Something like Regions Financial or Synovus, with operations across multiple states, costs hundreds of millions to build through acquisitions and years of organic growth. You are not starting one of these. You are buying into one, or you are spending a decade building toward it. And then there is the top of the pyramid. JP Morgan Chase has $3.9 trillion in assets. Bank of America sits at $3.3 trillion. These are not businesses in the traditional sense. They are financial infrastructure, the kind of institutions that governments consult before making monetary policy decisions. But the building is just the beginning. To open a bank in the United States, you need approval from either the Office of the Comptroller of the Currency for a national charter or from your state banking regulator for a state charter. The application process alone takes 12 to 24 months. The FDIC also needs to approve deposit insurance, without which no rational customer will ever walk through your doors. And once you are open, a small community bank spends roughly $500,000 a year on regulatory compliance alone. Compliance is not a startup cost. It is a permanent tax on the business that never goes away and only gets heavier over time. Where the money actually comes from. Now we get to the question that actually matters. How does a bank make money? The answer most people give is interest, and they are right, but they are only seeing the surface of it. When you deposit $1,000 into a checking account, the bank does not just hold that money for you, it lends most of it out. That $1,000 you deposited might become a $900 mortgage for your neighbor, which becomes a deposit at another bank, which becomes another loan, and so on. This is called the money multiplier. And it is the reason a bank with $1 billion in deposits can have $8 or $10 billion in outstanding loans. The profit engine sits in the gap between what the bank pays you for your deposit and what it charges the borrower for the loan. That gap has a name: net interest margin. A healthy community bank runs a net interest margin of around 3 to 4%. Sounds thin. Multiply it by several $billion in loans and it becomes the foundation of one of the most profitable industries in American history. But interest income is only one piece. The second piece is fees, and this is where modern banking has quietly shifted its center of gravity. Overdraft fees, monthly maintenance charges, wire transfer fees, ATM surcharges, loan origination fees. In 2023, American banks collected over $30 billion in overdraft and non-sufficient funds fees alone. A customer who never overdrafts is mildly profitable. A customer who overdrafts 4 times a year at $35 per incident is significantly more profitable, and they almost never notice it happening. The third piece is investment income. Banks also buy treasury bonds, mortgage-backed securities, and other financial instruments. The interest on those holdings flows directly to the bottom line. Put it all together and you have a 3-engine revenue machine. Interest income from loans, fee income from products and services,
investment income from the securities portfolio. Most businesses would envy having one reliable revenue stream. Banks are structurally built to have three running simultaneously. The architecture of trust. You have probably never thought about why you keep your money in a bank instead of a safe at home. The answer is not convenience, though that helps. The answer is a system specifically engineered to make you feel that your money is safer inside the bank than anywhere else. The most important piece of that system is FDIC insurance. Established after the bank runs of the Great Depression, the Federal Deposit Insurance Corporation guarantees deposits up to $250,000 per account. The moment that guarantee existed, the existential risk of keeping money in a bank evaporated for most Americans. You are not trusting the bank. You are trusting the federal government, which is a very different calculation. The second piece is the Federal Reserve itself. Banks with access to the Fed's discount window can borrow money overnight to cover temporary liquidity shortfalls. A bank that finds itself short on cash at the end of a business day does not have to sell assets into a panic. It borrows, covers the gap, and pays it back. That backstop is worth more than any marketing campaign in the history of finance. Why banks still fail? So, with guaranteed revenue from interest, a fee machine running in the background, federal deposit insurance, and a central bank standing by as a lender of last resort, why do banks fail at all? The short answer is credit risk, and the shorter answer is bad loans. Every loan a bank makes is a bet that the borrower will pay it back. When a bank makes too many bad bets, or when the economic environment shifts faster than the loan book can absorb, the losses pile up against the capital reserves. If the losses exceed the reserves, the bank is insolvent. Math does not care about brand equity. The 2008 financial crisis is the most dramatic modern example. Banks across the country had loaded their balance sheets with mortgage-backed securities tied to home loans made to borrowers who could not realistically service the debt. When housing prices stopped rising, the entire architecture came apart. Washington Mutual, the largest bank failure in American history, held $307 billion in assets when it collapsed in September 2008. It was gone in 9 days. But you do not need a global financial crisis to kill a bank. Silicon Valley Bank failed in March 2023 with $209 billion in assets. SVB had invested heavily in long-term treasury bonds during a period of low interest rates. When the Federal Reserve raised rates aggressively in 2022 and 2023, the value of those bonds dropped sharply. SVB was sitting on massive unrealized losses. The moment that information became publicly known, depositors tried to pull $42 billion in a single day. The bank could not cover it. It was over in 48 hours. Two mistakes show up in almost every famous bank failure. The first is concentration risk. When too much of the loan book is tied to one sector, one geography, or one type of borrower, a single shock can be catastrophic. The second is duration mismatch. When a bank funds long-term assets with short-term liabilities, it is permanently one confidence crisis away from collapse. SVB made both mistakes simultaneously, which is why it became a case study that will be taught in finance classrooms for the next 50 years. The real numbers. The economics of this industry sit in a strange place. A bank has one of the most structurally reliable revenue mechanisms in American business. People will always need to borrow money. Businesses will always need credit lines. The demand never goes away. And yet the industry produces some of the most spectacular failures in economic history. The revenue is reliable, but the risk is not. Every loan on the balance sheet is a future liability in disguise. Scenario 1. A community bank in the Midwest with $500 million in assets. After funding costs and operating expenses, you clear $6 to $7 million a year in net income. Steady, local, and recession-resistant in ways that most businesses are not. Scenario 2. A large regional bank with $50 billion in assets. Fee income and investment income push total revenue toward $1.4 billion annually. After expenses and provisions for loan losses, you net $350 to $400 million a year. In 2023, JP Morgan Chase reported $49.6 billion in net income, the most profitable year in the history of American banking. One institution, 1 year, more profit than the entire gross domestic product of several small countries. So if you do decide to buy a bank, just remember the one rule that separates the institutions still standing after 100 years from the ones that became case studies. The spread is guaranteed. The loans are not. Protect the loans.